You spot what looks like a perfect supply or demand zone. You set your entry, wait for the pullback, and execute the trade, only to watch the price move straight through your level, resulting in a stop-out. But a zone that doesn't hold still provides data. When these areas break, they signal that the previous trend has lost its momentum and that a new move is likely beginning in the opposite direction. Today, we are going to look at how to spot a failing zone before it officially breaks and how to map out a step-by-step countertrade to capture the momentum that follows. To follow along, go ahead and open up your preferred charting software and load up any major forex or crypto pair. By identifying these analytical pivots, you can take a failed setup and use its specific price action to structure an early entry opportunity. This chart shows flat, sideways price action followed by a massive surge of bullish candles, signifying institutional momentum. Look left for the final consolidation candle before the impulse. Draw a rectangular boundary encapsulating its body and wicks, extending right. This becomes your valid demand zone. A true zone requires an aggressive launch away from the box. That fast departure is evidence proving buying control originated from this specific price level. Strict discipline in drawing this origin zone is mandatory. If your baseline box is flawed, tracking its eventual failure becomes impossible. Let's advance the timeline. Eventually, the market returns to test this newly established demand zone. To measure buyer exhaustion and predict if this zone is likely to hold, we use a metric called the 3-tap rule. You need to count every independent touch of the zone. Here, we see touches 1, 2, and 3. Notice how none of these taps manage to push the price into a new structural high. Think of price strikes like a hammer hitting a brick wall. Repeated strikes weaken the structure until it eventually gives way. A strong demand zone repels price instantly. When price repeatedly lingers and fails to launch, it suggests buyers at this level are being absorbed. To declare a zone dead, wait for a full candlestick body to close entirely outside the opposite boundary. Once that body closes below the line, invalidate the original zone. You should no longer trade this as a support level. This visual break signals that the buyers have capitulated and that sellers have taken control of the immediate market flow. Waiting for a definitive candlestick body to close is the essential filter. It prevents being misled by wicks that temporarily pierce the zone before reversing. Now we map the countertrade. Look directly above current price to the downward break we just witnessed. Find the final small upward candle right before that drop and draw a new supply zone around it. This is your entry point. Next, scan far below the current price to locate the next extreme demand zone. This area rests at the absolute bottom of the movement and becomes your target. Your target zone must be fresh. If a previous wick has already tapped that lower zone, look for the next untested level further down. Bring up a standard risk to reward positioning tool. Anchor your entry at the new red supply box, set your stop loss just above it, and stretch your target line all the way down to that lower fresh demand zone. The failure of your initial zone provided the necessary evidence to build a structured asymmetrical countertrade. As the market unfolds, the price pulls back up, touches your entry line inside the new supply box, and then accelerates cleanly down to your target level. While an uneducated trader may stop after a single loss, trading the failure allows you to recover and capitalize on the resulting momentum. Open your charts right now. Scroll back to find the historically failed zone and map out the flip trade in hindsight. Building this muscle memory will help you identify the setup in live markets. Often, the clearest market movements occur immediately after a widely recognized technical level fails to hold.